Hello, everybody. My name is Bruce Montgomery, and this is my colleague, Tracy Prees.
Hey, everybody.
And we're with The Road to Retail. On our podcast, Tracy and I hope to offer tips, insights, ideas, and examples of how small, emerging, challenger consumer packaged goods, CPG, brands can grow and build their business. Everything from determining if you're ready to grow, where to start, how to prove it online, how to go about securing distribution at a national retailer, driving your business through to the consumer, and how to go about finding an investor if you're at that level. The bottom line is Tracy and I have made a lot of mistakes over our long time in the business, and we'd love to help you avoid some of them and help you grow your business by establishing and growing your brand, whether, again, online or in retail. Tracy.
Yeah, so Bruce and I, as he mentioned, have been in commercial operations in consumer packaged goods for over 30 years. And what we mean by commercial operations is sales, marketing, trade marketing, acquisitions, divestitures, distributor management, broker management, agency management. So we've had a lot of experience. And as Bruce mentioned, that's our goal, is to share our experiences, our successes, and our mistakes with our audience. And also on episodes, we invite colleagues, friends in the industry to be on our podcast. So today we've got an esteemed colleague and a good friend of ours, Ryan Springer. Ryan is one of the founders of Midnight Venture Partners, and we're going to talk about raising money today with Ryan. So Ryan, welcome to the podcast. Tell us a little bit about you and also about Midnight Venture Partners.
I like that you're liberal with the use of the word esteemed, Tracy. That's a pretty low bar. But my background, I grew up in natural, organic kind of food, beverage, beauty, and supplements. And I say that because my dad started a company called the Touch Agency in the 90s. Before that, he worked in the industry. I worked for him my whole life, actually, before I started Midnight about two and a half years ago. I saw a gap and kind of wanted to explore and get out of a shadow and do a little bit of my own thing on the investing side. When I worked for him, essentially what I would do would be, first I followed around for 2 years. Yeah, I thought that was going to be easy. He's like, you don't even have to work, just follow me and be on the calls. But he works like 14-hour days. So that was actually the worst part of my career. Just waking up early and being on calls, listening to him talk about the same stuff every day. And then eventually I kind of grew into a role of kind of an outsourced VP of sales or director of sales for multiple really fast growth companies. I've been in the trenches with Tracy before. We've done some cool stuff together. So it's really cool to be on this podcast. And yeah, you know, I come from the retail side. That's the piece I bring to the fund. I'm sure we can talk about Midnight later in terms of what we think makes us different and that kind of thing. But I'm really excited to be on this podcast.
That's awesome.
All right. Well, Ryan, welcome. And your dad is a very good dude, and working with him over the years was always exciting. And I guarantee he's thrilled to see the success you've had in spite of the teachings all of us give our children. Some of our children turn out to be successful.
Yeah.
So as we move into this now, what sort of, as you and your partners look at small, emerging challenger brands that come to you either through an email or you meet them at a trade show or a reco, what kind of a mental checklist or even a literal checklist do you think these small companies should run through in their mind before they think about raising money or trying to take on an investor?
Why do you need money? That'd be number one. Do you have a good reason? You know, I think a lot of people raise because they saw it on TV. And I think, you know, it's always very different and very obvious when you meet a brand and they've got a clear vision for where they're going and why they need money to get where they're going. So, you know, I would always argue that would be number one. And that's more in a general sense. In a more literal sense, why do you need money in terms of, I need, you know, I'm preparing to get into HEB or Walmart, or I want to take the next step. I need capital to be able to make inventory. I need capital to be able to market, you know, I need that kind of thing. So, you know, there's a whole list, but honestly, so few brands think of it that way. I would just be super clear, you know, why do you need it? And then the second piece is who's the right person to get it from? everyone hears venture capital and think I gotta get venture capital. That's the right way to do things. I'm supposed to do this. VC only fits for a certain amount of opportunities. Angels are usually a better fit, especially early. And then
Hey, Ryan, let me stop you right there, because you're using words that Tracy, you and I know, but would you mind giving an explanation in your vernacular of what's an angel investor, what's a venture investor? I think that that's important, and even friends and family, if you'll throw that one in.
Sure. Friends and family is super easy. It's friends and family of you, the founder, people that trust you, that know you. Usually they're writing really small checks, kind of leaning in on the business. Angels are high net worth individuals. These individuals typically have less of a connection to you. Oftentimes, your friends and family will connect you to them. They just enjoy investing in startups. They've made a lot of money. Oftentimes, their check size is between 50K and 250K. It can be even higher. You're a little more beholden to angels. Your friends and families, like your grandma giving you 25K. She's rooting for you. You're probably gonna have to report to them a little less. Angels, you have to have a close relationship with, show them kind of, what's going on there. Private equity is a whole different gigantic jump up. I'm not sure it's as much worth our time diving into that for these brands. If you're doing 8 million in revenue and you're doing it near profitably, go talk to a private equity fund. They might want to roll up, they might want to partner, that kind of thing. And then venture capital, and this is the piece I don't think a lot of brands understand. Venture capital is for brands that are trying to grow quite quickly and have a very, very high ceiling and want to kind of professionalize their business. But it also comes with a lot of oversight and a lot of opinions. And there are people who know what they're doing who will avoid venture entirely because they don't want that oversight. They don't want that opinion. They think, hey, I'm doing this. What's nice about venture is if you get the right investor and you're a founder, they can add an enormous amount of value through network. They're experts in the business in your category, whatever it might be. So venture check sizes, they can be as low as 100. They can be as high as 25 million. My fund, we fit around 500K to $1 million in terms of what we'll put in an individual company early on. And so I guess what I'm trying to say is a lot of these early founders just jump straight to venture. They're doing 100K in revenue run rate. And we've invested in pre-revenue companies before, but they're like a sauce company that wants to grow really slowly over the next 7 years. Don't go to venture. That's a waste of your time and their time. Go to friends and family, go to angels, get people aligned with your vision of the company. Because if you bring in a partner who's not aligned with your vision, I think you're asking for a huge headache.
Yeah, we're gonna get to how to select an investor in a bit. Tracy?
Yeah, no, that was great, great insight. And Bruce, I'm glad that you asked for those definitions. That really does help because the three of us, know this, just from our experience, but we want to make sure we're not talking over the heads of the, of our audience today.
And keep me honest, Tracy, because I'll start throwing in a bunch of industry lingo. We don't need that. So
next question. So what do you believe investors are looking for, Ryan, when they invest in a smaller company? Is it the brand? Is it the founder? Is it the intellectual property? What are you guys particularly looking for?
Boy, that differs by investor. So the first part's tough. And actually those different buckets are different things. Friends and family and angels, I think they look a little more for vanity and cool. Hey, I'm in this awesome, vegan dip company. I'm a vegan. I believe in this. I can show my friends. This is really fun. VC is a lot more metric based and category based, and they've got a lot more experience usually. For us personally, it's founder. That's first and foremost. Do we think this person's a winner? Are they open to coaching? Do they know what they're doing? Do they have a good network? Can they raise money? The last piece being the thing a lot of people overlook. You got to be able to raise money if you're going to be a venture invested backed founder. Even when we look at something, can this person go raise the next round when that time comes? So founder, first of all. Second of all is often category. Again, we talked about some categories before that are less venture-ish. We're looking for 15 to 25x minimum on the checks that we invest as a goal. If we don't see a pathway to that, if it seems like it could realistically get to 8x, we're not going to invest. That's not a profile of deal that fits the risk profile we need with the reward profile we need. And so I would say category, is there that ceiling, whatever that is. And then it's retention, sales velocity, metrics. Do people want this? Do they keep buying it? We see a lot of brands that spend a lot of marketing, especially on D2C, and no one's buying it again. Their average purchases is 1 to 2 times in a year. That's not enough unless you're selling couches or something, to be a scalable business. And finally, and these are, there's a bunch of other ones, but these 4 are like mandatory: gross margins and bones of a business, and burn rate that speaks to scalability. We don't want to help you get your boat to 100 miles an hour if there's a gigantic hole in it, in the form of low margins or high burn rate or a bad strategy. So I'd say those 4 things are the big 4. There's a ton more critical things, right? It's like anything, but that'd be where I'd start.
No, that's great, because you can't solve little problems till you solve the big ones, right? So worrying about those big ones. So Ryan, you touched on this a second ago, but let's circle back. So what do you think a company should look for in an investor or a founder? You hear some people that'll say things like, I just need cash. I know exactly what I'm doing. And to your point, you already made the reference of, hey, sometimes if you take the cash, you're going to get a lot of oversight. Sometimes you might get involved in the private equity world where you'll have to answer a lot of questions all the time without complaining. So what do you think a company should look for in an investor? And, what kind of profile, again, coming back to checklists, I kind of like them because they keep you honest. What kind of a checklist should that founder maybe sketch out when they say, you know what, I need to raise $500,000. Here's my profile of what I'm looking for.
So first of all, do I like this person? Because you're marrying them for a really extended period of time, longer than whatever you think it is. It's going to be longer than that. And you're going to go through hard times together. If things get hard, is this person going to handle adversity well with you? That's often where, actually, believe it or not, understanding the industry actually helps. I one of the reasons that we started Midnight, my partners Alex Bodney and Chris Adam and I, was we saw kind of investors who were very successful in, let's say, commercial real estate, coming in, writing checks into CPG and getting very frustrated with how CPG was. And they took that frustration out on the founders because they thought the founders were lying. That the Whole Foods buyer, why aren't they responding to you? It's their job to respond to you. That kind of thing. But that's not how buyers work, right? That's not how the leverage works. That's not how this whole system or jungle works. And so that's basically what I'm trying to say is, what do you want out of the relationship? Do you want somebody who just writes a check and checks in periodically and is real friendly? Well, that's fantastic. There's not very many of those. To your point, there are people who just want, there's not many, and you can't tell who they are, by the way. Whoever it is that you're looking at taking a check from, call some of their other investments if you can, get an idea of what they're like from other people that they've invested in. I think that's really valuable. But the larger thing that I'm trying to say is, unless you're the man or the woman or whatever, you're the best. I think value add investors are the best way to go. Somebody who can keep you honest. And what you need with that person is understanding, hey, how often do you want me to report to you? If it's every 2 weeks, you're going to call me, or you're going to call me upset on a Friday night because something happened, then I don't really want to do this. It's partially the investor you want. It's also like setting expectations early with the investor. So you can go back and say, hey, remember, I told you, I don't want to do X, Y, and Z. And we've signed up for this vision that we shared together. So to me, it's very much type of person, shared alignment, and then what do you want out of them? And then, talk to the friends and family. I'm sure any founder has friends and family who understand enough to be able to say, here's what I want. And that friends and family can go, well, that's VC. Well, that's private equity. That's an angel. Talk to your business savvy friends. I think founders that ask people for advice and are coachable, they have an exponentially higher chance.
Yeah, we've heard a lot, Ryan, which echoes what you just said about, you're definitely signing up to marry these people, making sure that you kind of roll with the same temperament, and then having some, area expertise. Like, is the person a distribution expert, or do they really know Whole Foods or marketing? So that's interesting. What do you think what should a company thinking of raising money know about the process? So when someone comes to you, do you guys, if they don't even know what to bring, are you like, we're done? Or do you guys say, hey, look, here's what we're going to be looking for so we don't waste each other's time? Is there, are you looking for the 5-year financial projection? Or are you looking for the 8-page deck that's super logical and you can grill this person because you know what their background is and past successes and failures? What should they bring to the party in terms of information?
You're going to want projections. You're going to want financial projections. You can get those relatively cheaply from, different people who build those. There's a lot of onesies who do that. And you should build, 1 through 5 years and then prepared to get those torn up by anybody who knows what they're doing. But just have them. A pitch deck is much better when it's shorter and straight to the point and sweeter than when it's this 26-page, like very information dense deck. I didn't ask for a business plan. When I see those, I don't click through them at all. It's just too much. It's too much stuff to try and get through. That's where I think brands don't often, I'm just going to speak from VC. Brands don't often put themselves in our seat and think like, man, is this busy person going to actually go through all of the, of this? Like, no way. Like that. I love the decks that are 10 to 15 slides. I can just click through it and see exactly where I want to go. Small, pro tip for brands, use DocSend when you're sending out your deck. It allows you to see where they've spent time, and you'll quickly understand what investors valued what in your deck. You're going to see them skip past a bunch of stuff. If they're smart, they're spending time on team, they're spending time on velocities and metrics, on burn rate, on all that stuff. So, it's if you want to outsmart yourself a little bit, it can be interesting to try and ask an investor ahead of time, sort of, hey, what are you looking for? I'll tailor what I'm sending you to this. What's important? I don't see brands do that a lot, and it's not that important to me overall. To your point earlier, I don't tell them ahead of time what I want. I kind of like to have them show up and see, what they're made of, what they got. And I never, ever let a brand present me a deck on a call. I went through it beforehand, or I didn't. I'm going to go through it later. What I want to do is pepper them with questions, just my style, and see if you know your numbers, if you can speak off the top, if you get it, if you're quick, how you handle pressure, a different plan than what you were expecting. All those things, I think, quickly can help you learn a lot about a person and how much they know about their business. I don't know if that's too all over the place as an answer, but that's sort of
That's good.
No, that's good. So I have one more part on this question, then I'm going to yield over to Tracy to add some color. So following this line of thinking, Ryan, what counsel would you give the audience of these small emerging founder-led brands when they're actually approaching an investor? I mean, is this something where you want that kind of formal meeting, or if something kind of happens through serendipity and you're at a conference, is it worth it to start literally with the elevator pitch over coffee in the corner at the conference, or is that just bad form? How do you say, if I'm trying to reach you, do you not even take a call unless it comes from somebody you trust? Do you answer like every fifth cold call just out of that's how you roll? How should a founder think about finding the person?
We look at everything, man. If you send it to info@midnightvp.com, we'll take a look at whatever you put. And my advice is to write an email blurb and have a really short deck attached that gets straight to the point. What are you? What are your metrics and momentum? Why are you the person to be doing this? What's going on? Why are you different? What's your point of difference? That kind of thing. Just nail those things and just give us an at a glance of like, this is interesting or not. This is a fit for us or not. And don't be offended if you send a bunch of info ad emails to funds and they don't reply, because no is a not reply to a info at email. No one's like going back and be like, hey, this isn't a fit for us. I haven't seen that a lot.
Yeah.
The best way is to a warm intro. And the oldest trick in the book is go on LinkedIn, type in my name. And if you're in the industry at all, you're going to end up having just a really crazy amount of mutual connections. That happens with any connected VC in CPG. I've gotten to the point where I'll Google somebody and put somebody on LinkedIn, it'll be like 105. Then you got to figure out who actually knows them and not. Most of them don't. But if you can get LinkedIn, if you can get a warm intro, I think that's a fantastic way to do it. But that's only if you can. If you got to reach out to info at a fund, that can work. Figure out events that they're at, follow them on LinkedIn, see what they're doing. That's a good way to get in front of them. We're open to just about any channel when it comes to inbound. We just give them different levels of attention. So to your point, the warm intro is an extremely high level of attention. Identifying them on Nielsen data might be even beyond that. Like, we came to you And then on the very bare end, the info we do look at those. That's not a waste of time. But I wouldn't expect a response if it's not a fit. And most of the time, it probably won't be.
Good comments there, Ryan. So I think what I liked about what you said, two things I want to highlight again is the co-founder or founder has to be coachable. And you do get those entrepreneurs who are a little, very sure of themselves or confident, but they have to be able to take, some constructive criticism and things like that, which again, when you're a founder, it can be hard. I really like what you said about that. And then two is that you don't look at the deck when you're talking to them. And to me, that's kind of like when you're presenting to a retail buyer. If you don't have the deck in front of you, can you really still, speak to the, your content and that you know it by heart?
Yeah, I like to pepper that. And also here's the flip side of that, right? With the deck side.
Yeah.
They're constantly presenting me stuff I don't care about, or I do care about, right? But if you let me ask the questions, I ask what I care about, what's going to move the needle, what's going to get my engagement committee to move. And that's burn rate, that's revenue run rate, that's growth, that's where's your strategy, where are you at next, where are you approved, what's your gross margin, how does that improve going forward, what's dangerous in terms of freight now, what's your team, why are you the person, what's your point of difference, what's your price point versus competition. I want to ask you all those, right? And then brands are constantly, and I understand why, and again, there's different kinds of consumers. Brands are constantly doing this thing that I kind of laugh at, where they're like, hey man, the coffee category is growing and it's really big. And I'm like, we spend like 10 minutes on that. I'm like, yeah, I know, man. I've NBC. No kidding, coffee is big. Let's talk about the stuff that matters on whether or not, we're wasting each other's time or this is really exciting.
Right.
And the fun part with that is when I ask, especially, this is most founders. I think most founders are good founders to a certain extent, just like most people are good people. When you start asking these questions that indicate, hey, this is a different kind of conversation, this is quick back and forth, I know what I want to know, they tend to settle into a rhythm, and you can tell they're actually more comfortable than when they were sitting there trying to regurgitate a bunch of stuff off a slide. You get to know each other better that way, I think. And then the first part you said about coachability, that's huge to us.
Yeah.
If we don't think you're coachable, you're not getting a check from Midnight Venture Partners. You get it from somebody else. We put together a team that is elite at operations, direct to consumer, and retail, and we love founders that are incredibly experienced or badass, but they don't want to listen to anything we have to say. They're just not fit.
Yeah. By the way, we've worked on a few of those with few of those founders in our past, haven't we, Ryan?
Yeah, we sure have. And it's really funny you say that. You remind me of something I wanted to say when you were talking earlier. One of the things I've enjoyed about Midnight is people have to listen to me more, because when we were consultants, people pay you to tell them your thoughts, but then they don't trust you because they're constantly worried that you're like being lazy or not, whatever. There's like other things. So it's funny how much less founders, now granted, I was younger and whatever, but how much less founders listened then when they were paying me to now when, maybe I will write a check, maybe I won't. It's and even when we do, we develop really good relationships with our founders, because what makes Midnight a little different is I want them to call me to bitch about stuff. I don't know if we're allowed to curse on this podcast, but I want them to call me to be upset, just like, hey man, this today sucked, and I'm really worried about this, and I'm not going to tell my other investors because I don't know what's going on there yet, but this is really scaring me. What do you guys think? What's your experience? What did you guys do when this happened? I'm worried that my credit line is going to go away with whatever interest rates going up. I'm worried that CVS's payment terms look a little different than I thought they'd be. I put this in my roadmap. What do I do now? Like that stuff. I saw you guys smile at that one, right? That stuff we all know well.
That never happens, Ryan. That never happens.
You, Bruce, you said the thing that was so true at the beginning. Founders listen to you when you talk about the scars, not that, I'm never sure when we do something right, I'm never sure that was the right way or we got lucky or whatever. But man, what the stuff you did was wrong. I brought brands to Walmart too early that ended up doing really poorly, not even because of the sales velocity, because of the shipping to all the DCs. There's so much you got to know. There's so many scars you can pick up in the industry. And that's what the founder wants to hear.
launching with too many stores and small brands. They get excited with that store count, and then they see what that first order is and realize they're not going to get paid for fill in the number, and all that cash goes out the door. Yeesh.
100%. And then they get the amount they're getting paid and they're like, what? Why is this number? Oh, because this, we took away from this, and here's a special other charge you weren't aware of, and here's half of your freaking PO,
Let's introduce you to Mr. Deduction. Who's he?
Yeah. Turns out all your stuff broke in transit. We don't know how, but you owe us this. That's the part you need to be able to get through to founders, even the really smart ones that come from Wall Street or whatever. They just can't know that part of the jungle. And that's why, guys like us exist. And that's why our fund was started at the seed stage, was to help founders early.
Interesting you say that. So dealing with a brand that's raised a lot of money, their head of commercial operations previous job was as a hedge fund manager. And, obviously this person is very smart, but they're struggling with like terms at HEB. Or how come I have to pay the distributor to get into KeHE? It's like, or into Sprouts. It's like, because you're in a different world now, man.
Yeah.
That Bruce, that part has offended me always. And I get why. I get why people from, traditionally really intelligent industries come into this and go, it's making cookies and putting them on a truck and getting them to Walmart. How hard could this be? Well, it works backwards of how it should often. It's purposefully the jungle. There's a reason Mad Men was about CPG products mostly, I think. And so, that part drives me a lot.
What's interesting about that, Ryan? I think most people think they can do CPG for this reason. I figured out after all these years, because everyone's a consumer. And because you're a consumer, you think that things that you buy should be easy to figure out the process.
And it's not.
I totally agree. And what they don't understand is the leverage piece. If you're a small brand, you have no leverage over anyone. No one owes you anything, and no one cares yet. You got to make them care. And that takes work and salesmanship and coming up with a good idea and then proving it out and doing it at a small scale. It takes time. This is not an overnight thing, in my opinion.
No, it's not. It's not for the faint of heart. So our next question, Ryan, I wanted to ask you, this kind of gets into best practices. So what's the best approach you've seen lately for a small emerging brand, to execute raising money? Give me a good case study of somebody that's wowed you, or like you feel like, man, they did it right. They had it all buttoned up, and they just knocked it out of the park with you guys. And you don't
Interesting. I'm trying to think of ones that are approachable. I'll give you one that's not approachable.
Okay.
We're about to finalize a deal this month. We just signed the paperwork. It's a second-time founder, same space. She had a big exit before. It's an HBC, Health Body Care. Sorry, that was a classic. You two would know that one. She's an HBC. She has an unbelievable set of investors she's brought in. I would argue the best VC in CPG. I won't say that name.
Yeah.
Another VC that's incredible, and a former founder who might as well be the mayor of Target, who started 2 ultra successful brands out of Target. And so naturally, she has an end cap at Target for like 6 months. She's got an unbelievable set of knowledge base around her. What I like so much about her is she knows she's done this. And the second time around, all she did was search out even more qualified people to bring on her team for opinions, super open to being coachable. She came to us and was like, look, I've got $1 million from this group. I got $1 million from this group. I have an unbelievable other founder who's involved. I want you guys, how do we make this work? She knew her numbers. She knew exactly where she was sitting, all that stuff. And that's not worth a time to someone starting a brand right now. It's like, okay, be incredible. Sure. So on the kind of flip side of that, on a founder that wasn't, first time, second time founder, I think the parts that we think are fun, and that leans even more into coachability, are the people who have been smart enough to have already asked. And this has a little in common with my last one. They've already asked people, hey, I've talked to people and they think I should start small in this city and I should focus here. And I'm going to keep my burn rate really low while I build a playbook for success. I know where I fit because I talked to X person. I need this amount of money. I was told it's going to be higher than I thought. It's going to cost this much and this much. You can absolutely be a first-time founder and get investment from VC. We do it, fairly often. They just have to be realistic in vision. They have to have clearly already been indicating that they're coachable. They have to understand that point of difference matters, and they have to understand that a low burn rate and high margin is kind of, it's not 2018 anymore on direct to consumer.
Right.
So again, I think it's a short, sweet pitch deck. It doesn't have to be over the top. It's financials that are realistic. And it's kind of an attitude of, hey, I want you guys to be a partner with me because I want this out of you. To go back to what we talked about really early, I love it when a founder knows what they want from us before they talk to us. It's not necessary, but it's always fun when they know enough about you to be like, I know you guys did Daily Harvest and Freshly as one of your partners, and another one did Amy's Kitchen and this other thing. And I want you on my team to help me understand my strategy. And that's
They've done their homework on
100%.
on you and on the category. And one of the things you said, which was really interesting too, is tell me what and Bruce uses this all the time on buyers. Tell me something I don't know, right? Educate me, make me feel like you're the expert. Don't tell me that the coffee category is growing. I already know that.
Right.
Really interesting.
Yeah, you say that to an angel. Angels might not know that, right? You say that to somebody who's made a bunch of money in medical device sales and is enjoying, investing smaller checks into startup brands because they're cool and it's a cool hobby and they like doing it and they've done well. Tell that person about coffee and that's going up. You know what I mean? Unless you're saying something controversial. Let's talk about market for sure, but prove the market beyond these really vague, broad things. Like an enormous amount of decks I see because they got told they had to have these like super vague assertions about category up or down that's like 30 billion. And you're like, okay, I get that you're talking TAM, but to your point, Tracy, understand your audience a little more. And, I would tailor it a little bit more than that, but that's a pet peeve more than that doesn't matter. I would not invest in a company because of a couple of slides. That's just a pet peeve.
Right. Gotcha. So on that, so we talked about, a best practice. So tell our audience about like the biggest mistake you've seen somebody make.
Oh boy, there's a lot. There's a lot. And I'm now really not going to use names.
Yeah, don't use the name. Just give me one that like, oh my gosh, I can't believe these people have called me and got a meeting with me and major rookie mistakes.
I had one guy call us to a Starbucks. He kept demanding we meet with him at this Starbucks in particular, which was interesting. And then he proceeded to be the single most arrogant person I've ever met in my entire life. And he's got no experience in this space. And he was just like, his whole attitude was like, man, it is such an honor for you to be here with me. You know what I mean?
Right.
I was not shocked. He kept telling me the round was going to close that week. Not 6 months later, I saw him at an event. He's still fundraising, same round. I'm like, oh, no kidding. You know what I mean? I had another one. I really got to be careful what I say here. I got another one where we caught the founder lying about almost everything.
Oh my.
On the surface, it seemed extremely interesting. And then as we kept pressing, it was, okay, so it's not this number, it's this, the margin's 20% lower than we thought. It's, this, and this. And lying is actually, well, we ended up getting to know him because we wanted to see what was there. Lying almost might be too strong a word. He was an eternal super optimist who lived 8 months from now constantly. We're going to get this. It's a done deal. And then those times have passed and they wouldn't have gotten it. And I'm like, well, that's why you can't think this way.
Right.
So, painting him as a liar would be wrong. But boy, be honest and be super upfront with your metrics and who you are and what you're doing. Because venture capital funds, some of these are not true. Some VCs are really going to call you on that and find it out and dig in and do all those things, man. You're not tangling. This isn't preschool kind of on that end of things.
Gets back to the old adage of, under promise, over deliver, and any number at the high end should be aggressively realistic, not aggressively aggressive.
I don't always take my own advice, but one area I take my own advice on is constantly asking for advice and learning stuff from people. And there's a family office guy out of Houston who told me this trick that I've grown to love. Whenever founders, they always do this. You ask them gross margin, like 50 to 60. And my buddy Mark would always write 45. Sales velocity, 10 to 12, 9. And man, it ended up being so accurate every time. And he just took this tax off of everything everyone said.
Sounds like golfing with Tracy. You know, there's always a couple of strokes missing when he records his score.
Exactly.
Right.
Hey, Tracy.
What'd you get on that hole? Five. Oh no, I think.
Yeah.
It looks like you are.
Let's head to the big finish, Tracy. It's getting a little loud.
Yeah, absolutely. So,
Oh,
Ryan,
sorry.
no. Thank you so much. This has been tremendously insightful and helpful. And we thank our audience for joining us. So please follow us on our YouTube channel. Everything is under Road, the number 2 Retail. And you can also find us on Spotify and on iTunes. And Ryan, how can people reach out to you if they want to connect with you? What's the best way for you to be reached?
I was almost just gonna throw just reach out to Tracy Priest, and he can screen you, and then they can be on me. I would say info@midnightvp.com, or what I said earlier, get on LinkedIn, see who the warm intros are. Somebody can vouch for you, and we can kind of go from there. Reach out to us, message us on LinkedIn, reach out to me directly on LinkedIn. That's actually a fantastic way I missed earlier. Anyway, like that, man, we're open to any conversation.
All right. Well, Ryan, thanks so much. It's been great advice, and wish you a happy holiday season. Tracy, take us out, man.
Absolutely. So again, thanks for joining us. This episode will be airing in January. And again, please follow us on our LinkedIn page, Road to Retail, or on our iTunes or Spotify channels. And we appreciate it. Talk to you soon.
Good luck
Thanks,
out
guys.
there.
See you.